Good afternoon, everybody. We have a number of people that are logging on, and Zoom is opening up our views here. So just a couple of minutes while Zoom gets everything populated. It's kind of fun to watch sometimes, as you see the count of participants growing as you start a call like this. Okay, I think we're mostly populated now, so good afternoon again. I'm Mike McCarthy. I'm going to be moderating the panel and our discussion today. I'm the managing partner at Hancock Askew. We're a full-service accounting and advisory firm. We have offices in Georgia and Florida. Joining me today, we're teaming up with some attorneys from HunterMaclean for this event. Since the launch of PPP and now PPP2 and the ERC and other things we're going to talk about today, both of our firms have been very busy helping a lot of our clients through application, through forgiveness, through trying to figure out how all of this works. We've seen so many different scenarios, and we're glad to be here to talk with you today. So I want to thank my panelists for their time and thank the organizers. We've had a number of people working behind the scenes at both of our firms to make sure that this goes off without a hitch. We have with us two lawyers today from HunterMaclean, Robert McGuirk and Louann Bronstein, and Sam Evans, a CPA with me at Hancock Askew, is joining me. All right, so Andrea, if you want to bring up the disclaimer, each of our panelists has a knowledge of PPP, and we are happy to give you our thoughts, but given that I have some lawyers on the phone with me today or on the call with me today, we've got a disclaimer that these are, our opinions and your very specific questions. We would encourage you to call us or talk to us one-on-one if you have a very specific situation. There is a chat feature in Zoom. You'll see that on the screen. If you have a question, please use that chat feature. And we've got some folks in the background that are going to be monitoring that chat feature and letting those of us know that there are questions come up so that we can respond to those as they come up. We are recording this webinar. So afterwards, you can certainly watch a recording, or if there's other people you can share this with. All right, we're going to pull up our first polling question of the day on PPP1, and we're going to get started with while you guys are responding to that, I'm going to go through the agenda. If we can go to the next slide. All right, and our agenda today is an overview of the first round of PPP, which Sam is going to cover. And then we're going to go through the second round of PPP, or PPP2, which Louann is going to cover. And then the employee retention tax credit, which Rob is going to cover near the end. So Sam, let me turn it over to you.
All right, great. Thank you, Mike, for the introduction. Andrea, if you want to go ahead and switch to our first slide. I'll briefly cover some of the statistics here. The box at the top is the global data that we have thus far, and this is as of February 3rd. Just an interesting thing to point out here, I want to highlight that, of the total volume here, the amount that's not forgiven, you can see that that's a relatively low amount. So we're finding, in my experience, have not seen very many instances where these funds have been required to be turned into a loan, or that the forgiveness was not granted. So I'd be interested if there was anyone in this group, if you wanted to reach out afterwards, but to learn maybe reasons as to why amounts were not fully forgiven, other than maybe the expenses were not there to cover the balance of the loan. But in most instances, we are seeing these being approved and forgiven. Another interesting point here is the under review line item in the top. You'll see that the average size of the loan in the under review bucket is generally much higher than the overall average size of the loan. And this can be contributed to the fact that the SBA is taking more time to review the larger balances. And if we all recall, the $2 million threshold for a required review from the SBA is still in effect. So that does bring that average size of the loan that is still out there under review. We also wanted to provide some statistics for more locally here, specifically to Florida, Georgia, and South Carolina. I've got two tables here, and I really wanted to highlight the 2021 table. So if we think about this, this is related to PPP loans that have been funded since January 11th, which is basically the second opening. So you had the first draw close in April 8th of last year, August 8th of last year. This year they reopened it on January 11th. So you can see the volumes here in 2021. This is just over the majority of January, the amount of volume that's here. And another data point here is the average loan size for those in 2021. You'll see that they're much higher than the average loan size of the global statistics we have above. It would just seem to me that this indicates a more needs-based approach, that the amounts that are being funded are, generally higher under this secondary loan program than they were to the general population from the onset. So I think this is a good chance here to go ahead and take a look at the results of the first poll. Andrea, can you pull those up? Okay, great. So again, this was a question as to where our population here stands with respect to the PPP funding. 18% of the group said that the loan has been funded, but you have not submitted for forgiveness. 23% of the group, we've submitted forgiveness, but we have not received a determination. 0% with partial forgiveness. We got 21% with full forgiveness, and 38% of the group here that did not apply. So that's interesting. Maybe some of the information that we provide you today may help you with maybe making that decision going forward. All right, we can move on to the next slide. All right, so what changed under some of the most recent law changes to specifically to the PPP loan? This particular change was one that was pretty highly anticipated by most people because we all are required to file tax returns in some order. There was a lot of discussion around whether the funds that were used to cover expenses under the loan were going to be deductible for tax purposes. And on December 27th, with the enactment of the most recent change, that was clarified to state that the expenses that are covered by your PPP loan are deductible. Historically, expenses paid from grant funds or non-taxable income were not allowed as deductions, but in this case, again, those that were paid with PPP loan funds were determined to be a deductible. There's a IRS positions here and revenue rulings that no longer apply. That's essentially the concept there being discussed. Paying for expenses with non-taxable funds. There's some general questions around the IRS guidance as to what companies should do with their disallowed expenses that they may have filed under a tax return already. For calendar year taxpayers, this typically isn't going to be the case. You haven't filed your return, so we have more clarification around the deductibility rules. But for those that were fiscal year ends, it may be possible that you filed your tax return under old guidance and didn't take deductions for those expenses covered by your PPP loan. But we do expect there to be some more guidance that comes out from the IRS. With respect to the last bullet point here on basis adjustments, the PPP loan is going to affect shareholder and partner basis, the timing of which is still a little bit uncertain. So further clarification here is expected, but there will be impacts to partner and shareholder basis for many small businesses that have received this loan. So Andrew, we can move on to the next slide. So under the new guidance, there was also a new application that came out for borrowers that had a PPP loan under $150,000. And the key term here is that it's a simplified, but it's not automatic, meaning, they didn't just grant forgiveness for everyone under $150,000, but it is far more simplified. You are still making a number of certifications and attestations you're signing your life away that you didn't do anything fraudulent. You are subject to penalties in the instance that you did. So it's very clearly stated in the application, but again, it's simplified, less data that needs to go into it. But there is a point here to make that you are required to retain records to prove your compliance with the requirements. And also, as part of the application, the SBA does have the right to request support for both your eligibility and the amount of forgiveness. So while it's not necessarily going onto the face of the application, it is still important to retain that information. We can go on to the next slide. So what we want to highlight here is that there are new expenses that can be considered forgivable costs following the latest changes. The first one here is that payroll costs can now include your group term, disability, and vision and dental insurance. Historically, this was limited to cash compensation and other benefits, retirement and health, but it's been opened up to another of other insurance programs that many employers provide. And again, that falls within your payroll costs. The additional expenses that are included below that, these are all considered non-payroll costs that can be used for forgiveness expenses. So these are just the changes. And the first one being the covered operations expenditures. So if we think about changes to our business in order to work under this new normal, for instance, us having a virtual presentation here, many companies did have to pivot, make investments, changes to their infrastructure in order to accommodate the new way of doing business. So those would follow under covered operations expenditures. Covered property damage costs. So these are related to any costs that have been incurred by a business that were not covered under insurance, related to a lot of the unrest and the looting from the 2020 public disturbances. So those also were included as non-payroll forgivable costs. There's this concept of covered supplier costs. So if you think about a restaurant, for instance, that might have a legal obligation to purchase a certain volume of food prior to their covered period, well, they couldn't make changes or pivot quickly enough, and that food is subject to spoilage. And if you don't have customers coming into your restaurant, you can't sell the food. So this was put in place to help instances like that. And then there's this covered worker protection expenditures. And this can be operational or capital expenditures used to comply with CDC guidelines and those requirements in response to COVID-19. So if you think about PPE required for your employees, filtration systems, sneeze guards, changing the footprint of your dining areas, things of that nature fall under the covered worker protection expenditures. Again, this is just the incremental changes to non-payroll costs. Amounts for interest, rent, and utilities are still included as non-payroll costs that can be forgiven. This change is made effective retroactively to the effective date of the CARES Act, so all the way back to the beginning of the PPP program. But also please remember that these non-payroll costs can't make up more than 40% of the forgivable amount of your PPP loan. All right, we can move on to the next slide. So there were also changes to the end of the what's considered the covered period. If you all recall, the covered period is the 8 to 24 week period beyond the point at which you receive funding under the PPP loan, in which you're incurring and accumulating forgivable costs. So the start of the covered period didn't change. It starts immediately once you receive the disbursement of the funds. However, now you have the flexibility to select at least 8 weeks, but no more than 24 weeks. So you could even start your forgiveness application between the 8 and 24 week window had you spent the funds, and you can just define the covered period within that window. It removes this concept of the alternative payroll covered period. All that had to do was realigning your covered period with your very next payroll period. Again, there's accrued and paid expenses that are occurred in your covered period that are going to be covered here regardless. And then changes to the covered period that impact your safe harbor requirements. So If you recall, this is borrowers that reduce wage or employment levels. One moment. They're gonna have to. Yep. Okay. I can't. The next one.
Sam, did we lose you?
Apologies, I have a conflict here. I think I got into the room here a little early, but sorry for that interruption. Let me get back to the covered period here, and as far as its impacts on the safe harbor. So borrowers, they are required to reduce the wage, or that reduce wage or employment levels will submit or lose some of that forgiveness. But for loans that were issued before August 9th, that safe harbor requirement is by the December 31st, 2020 deadline. And for new borrowers, including those under the second draw loan, the safe harbor must be satisfied by the end of the covered period. And if you recall, safe harbor is just restoring the full-time equivalents, or also restoring wage levels to pre-covered period levels. All right, we can move on to the next slide. There are some other provisions here that were affecting forgiveness that have now changed as a result of the latest act. And the first one here being the EIDL grants that were advanced to borrowers no longer reduce the amount of the PPP forgiveness amount. And what was happening is loan recipients were initially applying for this EIDL grant, which is a $10,000 injection that wouldn't be considered taxable and wouldn't need to be paid back. But the timing of that program and the timing of the PPP loan program didn't necessarily sync up. So when PPP borrowers were going in to fill out an application, you were required to actually deduct the amount of the EIDL grant that you originally received. That wasn't necessarily always happening on PPP loan applications. And when it came time to forgiveness, there was a lot of confusion and back and forth as to what the full amount of forgiveness would be. This new rule came out that the EIDL is not going to impact your forgiveness, and that those amounts will be remitted to the lenders. So that will be wiped off of your PPP loan amount. And then the last bullet point here, any payroll costs that are used to support the employee retention credit, they can't be used for PPP loan forgiveness, which makes sense. That would be, in a sense, double dipping were you to include it for both. But the borrower does have an option to choose whether they apply the wages towards the employee retention credit or against their PPP loan. So there is some room for planning, and some consulting on the best way to apply your payroll or your wages in the event you have not received forgiveness on your loan or applied for forgiveness yet. We'll go to the next slide. So the question here is, if I didn't get the first round of PPP lending, can I still get it? And the short answer to that is yes. The application deadline has been extended to March 31st, or the time at which they exhaust the funds. I don't know as of today how much is available left in funds, but I would imagine that there's enough there to take it through the end based off of the first round. But I think I don't have the data to back that up at the moment. The Economic Aid Act is here. It makes certain employers eligible. So other employers are now eligible under the new rules. You can see here the 501c6 organizations other than professional sports leagues are allowed. Certain organizations involved in lobbying or participating in capital campaigns are also not allowed. They've expanded it to news organizations, housing cooperatives, destination marketing organizations, and those now you can see have a lower employee threshold of 300 employees. They do specifically bar the following individuals or entities from borrowing under the PPP program, and that would be publicly traded entities for new loans, the 501c6 entities that are professional sports leagues, and then entities that receive a grant under new program for Save Our Stages. So I just thought it would be interesting to point this out. As far as professional sports leagues go, I don't know if the group here recalls, but when the PPP program first came out, the Los Angeles Lakers actually obtained a loan. I'm in the middle of the actually obtained a loan for $4.6 million, a PPP loan. Amidst much public outcry, they did actually return that loan amount back to the SBA. So I thought it would be interesting to just check in and see how the Lakers are doing, since they had to give back that $4.6 million. And I did find out that in December of 2020, Anthony Davis was awarded a 5-year contract worth $190 million. And LeBron James got a 2-year contract worth $85 million. So I think at this point that they're doing okay. And then it was probably a good decision to give those funds back. All right, let me go to the next slide here. With respect to increasing the original amount of the loan, some borrowers can seek an increase to the original amount of the loan without it being considered a second draw. And I haven't seen too many instances in which this would apply, but we have some points here on who would be eligible. And it would be an entity that returns amounts or didn't accept the full amount under the initial application. Partnerships maybe that didn't submit their partner compensation, or seasonal employers that benefited from new changes with respect to full-time equivalents of seasonal employees. And this guidance came out effective in January 6, 2021. With that, that covers my portion. So Mike, I'll turn it back over to you to move into our next.
Thank you. Appreciate that, your time and the overview of PPP1. And again, for those out there, there's still some money available if you want to apply under that program. We're going to shift gears now to PPP2. And Andrea, why don't we do another poll before Louann begins? So the question is, do you plan on applying for PPP2? And we'll turn it over to Louann to get started, and she'll go through the results.
Thank you. So I will read the question for purposes of recording. Do you plan on applying for PPP2 funding? There are 4 choices. 1, I already have. 2, yes, but have not done so. 3, no. And 4, undecided. And Andrea, I'm ready. If you could take the poll down, Andrea.
Louann, you can close it on your machine.
I tried without success. There we go. Thank you. Technology challenged over here, but I'll launch right in. So the PPP loans, who was eligible? I guess first I will say that to Sam's point, there has been with PPP2 some benefit of lessons learned, including points that people found to be outrageous in PPP1. So one point is the PPP1 rollout was very bumpy. I think that is no secret. PPP2 has been going much smoother. I read that through February 21st, 100 million in loans and second draw have been deployed out of the 284 million total. So who is eligible for the remaining money if you're on the call and still considering it? First, you must have received a first draw PPP. So I think it's interesting the number of people on the call have not participated in the first draw. So for those people, I think you would go back to Sam's slides and see how you might participate in PPP1. So first, must have participated in PPP1. Second, you've used or will use by the time you receive the second draw the full amount of the first draw. A little change from first draw, it's for employers of no more than 300 employees. And it's generally measured in total, except there are the same exceptions for lodging and food service that are measured by location. And this is a reduction from the 500 employee limit and the first draw PPP as originally launched. So must have had a 25% reduction in gross receipts during any quarter of 2020 for from gross receipts during the same quarter in 2019 if you were in business of all of 2019. But I'll stop here for a second. One of our advanced questions was to this very point. And in January, I think it was January 19th, the SBA issued guidance in form of Q&A that clarified this. So if you were in business all of 2019 and 2020, then you could do a comparison of your annual receipts. So you have a choice of doing it, the comparison same quarter to same quarter, or annual receipts of 2020 versus annual receipts of 2019. And that's because, of course, if you were down, in order to be down annually by 20% or more, then you must have been down one quarter by 25% or more. So I think, again, it's in recognition of making this a little bit more straightforward. And you can evidence that, as I've noted at the bottom of the slide, by your annual IRS income tax filings for the entity, if you're using an annual reference period. And at the risk of offending Hancock Askew, I may be simplifying this when stating that if the entity hasn't yet filed its 2020 return, it can, in my view, file what's a partial return, that you compete the gross receipts part and you've certified that that portion of the return won't change. So you can go ahead and have your evidence of the 25% decrease. And then, if you weren't in business for all of 2019, all is not lost. You could still receive the second draw. The comparison just starts to be a little bit different, and I won't go through them all. But for example, if you were not in business the first or second quarter of 2019, then you could take any quarter of 2020 and compare it against third and fourth quarter of 2019 and so on, except you get to the point that you must have been in business operations as of February 15th, 2020 in order to qualify for a second draw. And then finally, in addition to tax forms, you can use quarterly financial statements, bank statements. Of course, all of these must be in reasonable detail to show what your gross receipts were and to show that there's been a decline. So Andrea, next slide. Okay, so who is not eligible? And I think I'm okay on time, so I'll take 1 minute to read from an article that I read in preparing for this webinar. And that goes to the first, basically companies with ties to China. And again, I guess this may be not so much lessons learned, but part of outrage. So Congress made clear that its members believe China is to blame for the devastation caused by the pandemic. Legislatures emphasized that intent was to provide PPP loans to small businesses and nonprofits while preventing a single penny from flowing to China. Speakers on the floor of the House of Representatives stated, among other strongly worded criticism, that if China had been honest about the virus, 95% of the crisis would have been contained. And the author there goes on to note that it's interesting, for those reasons, that ties to China was singled out, but not other countries that we might normally think of, like North Korea or Russia. So, and it might not be that not any single penny goes to China. For example, the Chinese company holds 20% or less of the shares of stock in the company, that entity is still eligible for a loan. And then it's probably not that applicable to many people on the call, but there's discussion, well, what if you redeemed the interest of the Chinese owners, then could you get your loan? And some of those questions actually are not answered, but they're interesting. So to proceed on, grant for shuttered venue, because as Sam has mentioned, those businesses were covered by other aid. listed, traded on a national securities exchange. Again, outrage and PPP 1, and it goes against the intent that it's to help small businesses stay alive in the struggle. The next we'll skip over. They probably don't apply to that many on the call. Permanently closed, that probably goes without saying, but it's been said in the regulations, so no doubt they are permanently closed, no loan. And then there's a category of gray area, and I think we had an advanced question on this, which I won't address here, but it does fit in here. Then that is if there's any unresolved issue relating to your first PPP loan, and that doesn't mean whether or not it's been forgiven, but if there's a question about how something was calculated, if that's not resolved, then you can't get a second draw PPP until that issue has been resolved with the SBA. So Andrea, next slide. So here are just some fast facts about the second draw PPP. Maturity 5 years, interest rate 1%, so it's still super low interest rate. How much is the loan? General rule of thumb is it's no more than $2 million in any scenario, but it's going to be lesser of, in general, 2.5 times annual total monthly payroll cost for 2019 or 2020. Borrower gets to select which year, or 20 million. And there's an exception made bumping it up to 3.5 times for NAIC code 72, which is lodging and hospitality. Other borrower favorable points, still no collateral required, no personal guarantees. An interesting point for a number of my clients is foreign ownership. It's not prohibited unless China owned, but I have discovered that the practical issues with the SBA's form make it difficult to fill in the blank of who are the owners, and the owner is a foreign entity, because the form contemplates that the shareholder owner must have a taxpayer identification number, and if it's a foreign entity, it won't. Moreover, in general, it can't get one. So clients have found some pretty clever ways around that when you have an online form only, and you have to put something in just to get past the hurdle. So dates to apply, we're again, 100 million has already been dispersed, but we're about halfway through the period, but there's still time if people are undecided, because you have until March 31 to apply, and you apply it by using SBA form 2483 SD. And again, it's my understanding that in PPP1, you can use a paper form or online. What I'm hearing now is it's all online form only. So Andrea, I think you might have poll results. So great, I'll just read them out really quickly. Do you plan on applying for PPP2 funding? Already have 19%. Yes, but have not done so yet, 23%. So good news, you have some time left to do that, and there's money left. No, 38%, and undecided, 19%. And I have one final slide, Andrea. So this does not relate to the second draw PPP, but it relates to my practice area. My focus is on mergers and acquisitions. So the PPP loan, whether or not, in particular, seller has a PPP loan, it has been a hot topic. It was probably a really hot topic until October 2nd, 2020, because before that, there was just speculation as to how it would be handled, but the SBA issued a procedural notice on October 2nd that lays out what is summarized here in my chart in greater detail. And I've had a couple transactions now where seller has a PPP loan, sometimes a relatively small one, but it's just, so how do you go through the steps of handling that? And I will pick up the pace a bit here to stay on track. But first, there has to be a change of ownership, and it's particularly defined. So at least 20% of the common stock or other ownership interests, like membership interest in LLC, of the borrower is sold or transferred. And it doesn't have to be to a third party, it's including to an affiliate. So first trigger, 20% or more of ownership interest. The next bucket is PPP borrowers, sells or transfers at least 50% of its assets. So that's less than what we might commonly think of all or substantially all of the assets. Or the borrower merges into another entity. So the PPP note has been fully satisfied, and that means either repaid in full or the loan forgiveness process has been completed, then no issue. And if I wrote it down correctly, in the first poll, 21% responded that their loan had been forgiven. So for those people, if you're considering a sale of business, no problem, you can stop at the first box. For those 23% or so where it's been submitted, the note's are not fully satisfied because the forgiveness process has not been completed. So you would move on to the next bucket. So not fully satisfied, then either the lender alone approves or the SBA must approve. So if it's structured as a sale of ownership interest or a merger, and the sales for 50% or less of the interest. So, in my mind, it's not a change of control, that the original owners or borrowers still have control, then no problem. Lender approval not required. So if you're between 20 and less than 50, even though there's a change in ownership, no problem. Or if it's 50% or more, then the borrower has to complete and submit a forgiveness application, which I think many of you have done, and establish an escrow account controlled by the PPP lender with funds equal to the outstanding balance of the loan. And that's where I think it could be painful, because the business borrowed the money because it needed it. What if you're called upon to establish an escrow account funded, for example, at $2 million loan balance, while you wait for the lender to approve and the sale to close? So if it's structured as an asset sale, it's sale of 50% or more of the assets, so no difference in the trigger and change of ownership, because that's 50% or more of its assets. And borrower establishes the escrow account, same as for sale of stock. Then the next level is if the above conditions are not met, lender cannot unilaterally approve it. It really, I guess, gets escalated up. The SBA must approve it. And that can be problematic because the SBA has 60 days to review, and sellers with PPP loans and buyers also really need to take that into account and figure out early on in the sale process how that's going to be handled to avoid, if you're following the requirements, to avoid this delaying the closing of the transaction. So with that, I will stop and hand it over to Mike.
Well, thank you for those comments. There are certainly a lot of clients that have done transactions in this past year, so that's very applicable to a lot of people. So moving on from PPP1 and PPP2, we're going to talk about the employee retention payroll tax credit. If we can do another quick poll, Andrea, on the employee retention credit, whether somebody has already applied, not yet applied, but planning to apply, not applying, or undecided. We'll take that poll, and Rob will take it off from here on the ERC credit.
Well, that's great. Thanks very much, Mike. I appreciate it. Andrea, if we could move to the next slide, please. And Andrea, if we have the poll results in, before we get into the details, maybe we could bring them up on the screen. So do you plan on applying for the credit? 22% say yes, 39% say no, and 39% are undecided. Now, I look back to the earlier poll that said that 62% applied for the PPP. We're going to talk about, under the prior law, they were not eligible for the employee retention credit. Under the changes in December, they now become eligible. So we'll see after we go through this whether these percentages change. So the employee retention credit, just for a little bit of background, it was enacted as part of the CARES Act. And originally, as Sam mentioned, if you receive paycheck funds, you are not eligible for the credit. In December, new legislation came into effect. And one of the big changes is that those who have received paycheck loans potentially are eligible. And because of that, we're going to be talking about the rules that apply in 2020, because there may be an opportunity for some of you to go back and file amended 941 payroll returns to claim the retention credit for 2020. The December legislation also extended the program, which was scheduled to end at the end of 2020, through the first 2 quarters of 2021. So it goes now through June 30, 2021. We're going to talk a little bit about this more, about the concept of no double dipping. If you have a paycheck loan, it's important to understand that to the extent that you used payroll expenses to substantiate the loan forgiveness, you cannot also claim an employee retention credit on those same wages. We're going to talk a little bit about that. But for that reason, anyone who hasn't yet filed for paycheck loan forgiveness for their 2020 loan, who is thinking about maybe going back and claiming the credit for 2020, they do want to give some consideration to how much wages that they'll claim for the forgiveness and how much they'll reserve for the employee retention credit. You know, as Sam explained, to get the maximum forgiveness, you need to use 60% of the loan funds for payroll, but that means you could use 40% for non-payroll. So to the extent that you preserve some of your payroll, that might be eligible for the employee retention credit. Andrea, can you skip to the next slide, please? So what is this employee retention credit, and what does it mean? So for 2020, if you qualified, the maximum amount of credit that you could get in 2020 for any one employee was $5,000, which was basically it was a 50% credit percentage applied against a maximum of $10,000 of wages and healthcare expenses for a particular employee. Well, for 2021, the credit has been substantially increased. And now the credit percentage has been increased to 70% from 50%. And it's on a quarterly basis. So if you qualify for both quarters of 2021, and let's say the employee in each quarter had maximum compensation and healthcare of $10,000 each, well, that would be a total credit of $14,000 for one employee for 2021. Now, who qualifies for this credit? Whether it's 2020 or 2021, there's two ways you can qualify. You can qualify because you suffered a revenue reduction as compared to 2019, or you can qualify because your business was subject to a full or partial government shutdown order. In 2020, it was a fairly high hurdle in terms of the revenue reduction. You had to show 50% revenue reduction as compared to the same quarter in 2019. Well, the legislation in December for the credit in 2021 has reduced that to say you only need to show a 20% reduction in either the first or second quarter of 21 as compared to the same quarter in 2019. So that is an easier hurdle. But even if you didn't suffer the revenue reduction, as I said, you may be able to qualify based on a partial or government shutdown. So let's talk a little bit about that. Andrea, could you move to the next slide, please? So, in 2020, when you think about it, there was a lot of government orders impacting your business, shutdown orders or partial orders. There's less so in 2021. So this discussion may be more relevant for you who are thinking about going back and amending payroll returns for 2020 to claim the credit for 2020. But so in terms of a government shutdown order, it has to have been an order that was mandated. It can't be suggestive in nature or a recommendation that you chose to follow. It had to be an actual order that you were required to follow. The other thing is that some of these orders impacted your customers. For example, it may have been a stay-at-home order, and so customers in nearby neighborhoods or regions, they couldn't visit your business. Certainly that impacted your business, but that's not viewed as a shutdown order applicable to you. Now, obviously that may affect and probably did your revenue. And so maybe you qualify on that other basis, a reduction of revenue. Many of you, especially during 2020, were in areas where your office was required to be closed because you were a non-essential business. But for some of you, particularly professional service firms, you could have easily, and maybe did, shift your employees to remote working and really didn't suffer too much of an impact. So even though you were subject to an office closure, for those type of businesses, you're not considered to benefit from satisfying the shutdown rules. Andrea, could you go to the next slide, please? Sort of conversely, if the government actually ordered your business to shut down, then you are impacted. You would qualify on that basis. I mean, I can think of fitness centers, bowling alleys, movie theaters, restaurants. They were ordered not to operate. Certainly, they would qualify under the shutdown. We said that, orders that affected your customers don't count, but it's possible that shutdown orders that affected your suppliers would count for you. If you were not able to procure sort of critical goods that were needed for your business operations and that impacted your business operations, then that type of order would count for you. And if your office or work area was closed and it wasn't possible to work remotely, or you could work remotely, but only on a limited basis, then that counts. I think there's an example of sort of like physical therapy, where the physical therapist could do some paperwork at home, but obviously they couldn't serve their patients because the patients needed to go to the facility where the equipment was. Well, that would count. Andrea, could you move to the next slide, please? So what's a government order? Well, it's what you would typically think would be a government order. It could be an order from the city mayor requiring non-essential businesses to close. It could be a state emergency proclamation to shelter in place, and so your employees couldn't get to work. It could be an order imposing curfew. For example, you're a restaurant or a bar and you have a lot of business at night, that would have impacted you. It could have been a health department order that required you to close down for a period to conduct cleaning or disinfecting. Andrea, could you move to the next slide? So let's give we're going to run through a couple of quick examples. What counts, what doesn't count. Here's a car dealership. Its customers in the area were ordered to stay at home, and that affected its revenue, certainly. But that doesn't qualify as a shutdown order for this car dealership. Now, maybe the car dealership suffered a significant decline in revenue and can qualify on that basis. Andrea, let's look at the next example. So here's an example where, very typical, shutdown. The restaurant was ordered to close its in-room dining, but could do takeout service. This is a shutdown order, a partial shutdown order. This would count. There's another example where the restaurant was allowed to do in-room dining, but at a very reduced capacity, like 20%. That counts as well. Andrea, let's look at the next example. Well, here you have an accounting firm that was a non-essential business. I don't know how they could say an accounting firm's not essential, but they did. And because they're professional service firms and their employees are very adept at technology, they could very easily transition to work at home. So for this accounting business, they can't qualify even though their office was closed based on a partial shutdown. And I think this is the final example, a meat packing plant, 3 shifts a day. The health department said that they, one of their shifts, they had to spend cleaning and disinfecting. Well, this is a partial government shutdown, so this does qualify. If we could turn to the next slide. Before we get into qualifying based on declining gross receipts, one thing I'd like to mention about the partial or full government shutdown is it only applies for the period of time, the wages during the period of time that the order was in place and that it impacted your business. Once the order is lifted, even in mid-quarter, wages after that period don't qualify. In contrast, you may be able to show that you suffered a significant decline in gross receipts. Now, in 2020, we mentioned you would have to show that for a particular quarter, you suffered a decline of 50% versus the comparable quarter in 2019. And one of the things about this in 2020 was you would continue to qualify into the next quarter until you reacquired 80%. Let's skip to the next. We've got to kind of quicken it up here a little bit, pick up the pace. Could you do the next? So for 2020, again, it's 50% credit. One of the important things I want to mention here is if you had less than 100 employees and you qualified, the credit would apply to all of your wages, even the folks not working. But if you were over 100 employees, then it only applies to the folks that are not working, the people that are on furlough that you're paying. And this 100-person test is applied on an aggregate group basis. If we could skip to the next slide, please. So for 2021, things have gotten a little bit better. Now for the revenue decline, you only need to show a 20% revenue decline instead of a 50%. And again, we're looking to the applicable quarter in 2019, which, when you think about it, 2021 Q1, you'd be comparing to 2019 Q1. You may not have been affected in Q1 of 19. So they allow you for 2021 to look to the prior quarter. So for Q1 2021, you could choose to elect to look to the prior quarter, Q4 2020 compared to Q4 2019. Similarly for Q2, you could look to Q1 2021 to Q1 2019. One of the big changes for 2021, and it's really great, is that if you have less than 500 employees, the credit applies to all of your employee wages. It's only for those who have more than 500 employees that it only applies to wages for people that don't work. So with all of that background, maybe we could pull up the final slide to see whether any of this has impacted the final question, Andrea, whether this has impacted your decision to claim the credit. So with what you have learned about the employee retention credit, are you more likely to apply for it, less likely to apply, or your plan has not changed? Let's see what the results are. Andrea, do we have the poll results?
While we're waiting on that, we're about 5 minutes from finishing. We want to keep this to an hour and be respectful of people's time. So we appreciate that very much. Andrea, you can just put up those slides. There we go, whenever. So 39% are more likely to apply, 11% are less likely to apply, and 50% said their plan hasn't changed, which probably means they're still looking at it. This is a tremendous amount of help, whether it's PPP1, PPP2, or the employer retention credit, that has been made available to people. If you qualify, certainly you should be looking at these things. And these are real money. There are some, that $5,000 per employee, if you've got 50 employees, that's $250,000 potentially that's available to you to offset and help pay your costs. So these are real programs that are available. So a couple of questions have come through. Want to try and address those where we can. Does the ERC apply to owner employees in an S Corp? Yes, it applies basically to everybody that gets a W-2. So if the owner is getting W-2 wages, it would not apply to any distribution wages, but it would apply to any wages paid through regular payroll that payroll taxes are being paid on. We had another question come in earlier related to a subsidiary applying for PPP. So if a company has more than 25%, less than 25% of revenue reduction, they don't qualify. But what if one subsidiary has more than 25%? I believe the answer, that's specific, and I need to understand the facts, but the answer is look at the top level. There's some affiliate rules there. So it would look at the total company in that area. I don't know if there are any other questions that have come through. If anybody does, please ask those. There's a chat feature there if you want to type in additional questions. Andrea, will you put up our contact information while we're here? So if you have a question, go ahead and ask that, and we'll stay on the line for a little while to try and answer those. I think most people are going to drop off here at the end, but I wanted to thank you all for your time. Thank you for attending. The contact information for everybody on the program, for the 4 panelists on the program, is there, phone number and email. So if you have something specific, feel free to email any one of us. And if you didn't remember which person covered which topic, that's okay. Just email any one of us. We tend to share questions amongst each other and make sure we get things answered for people. So we're happy to do that. There will be a recording, and anybody that signed up for this will get an email with the recording and the slides from today's presentation. So those will be made available to you. All right, well, with that, we are going to go ahead and close out. It is 2:58, so we're 2 minutes early. Oh, one last question coming in. A couple of last questions. Okay. Those of you that want to drop, please do. We'll try and stay on for a minute or two here to answer a few of these questions. The PPP to determine 2.5 months of payroll as the amount of the loan. So for PPP2, I think this question is the 2.5 months the same determinant as PPP1? And the answer generally from those I've seen that are applying is yes. The PPP2 is ending up about the same amount, around the same criteria as PPP1, unless you had a significant change in the number of employees working for you between PPP1 and PPP2. Can we allocate payroll to either the ERC or the PPP during the same period? The answer to that is basically yes, but you can't double dip. So if you use your payroll for your PPP forgiveness, you cannot also get the ERC on it. So what typically is happening is people are using payroll for a portion of their PPP forgiveness. And you also using rent, utilities, other things Sam mentioned earlier. And then in the following quarter, after they've used up their PPP money paying payroll, they're still paying payroll the following quarter. That's the quarter they apply for the ERC credit in that period. But you cannot double dip on that. The forgiveness rules for PPP2, there's a question, are they any different than PPP1? They're actually a little more liberal. They allowed a little bit more expenses to be applied, but generally they are the same. All right. Well, thank you all for your time today, and we are going to go ahead and close down, but feel free to email us if you have any questions. Thank you.